Hi guys, I'm Matt Atwood, a CFP here at Timewise Financial. And today we wanted to take a moment to answer a question that was asked by you guys, the viewers. So recently we did a poll to see what you guys wanted to hear about. And overwhelming response was what's going on in the real estate market. And so we want to know, one, we heard you. And for future videos, if you guys want to hear about something else, don't hesitate to reach out. Shoot us an email, comment on one of our videos, and we'll cover whatever it is that you guys want to hear about. That being said, let's jump right in. So the real estate market affects everyone. If you have shelter in this country, you're affected by the real estate market in one way or another, whether you're a renter, a buyer, a homeowner, you're affected by what's going on. And also, being as it affects everyone, it's a huge part of the U.S. economy. Almost 17% of our GDP is tied to what's going on in the real estate market. And it makes sense when you start to think about what's included in the real estate market. It's not just buyers and sellers and realtors. You have construction, both on the residential and commercial side. You have a bunch of associated industries, whether it be banking, Home Depots for home improvement, attorneys or realtors, and much, much more. For this reason, the real estate market's health is really important in terms of the health of our overall economy. So let's take a look at what we're going to cover today. We're going to look at what happened last year and why. We're going to look at, what the Federal Reserve has done to try to cool things off, how that has affected housing inventory, how rates going up affect buyers, as well as at the end, we'll take a look at a case study of housing affordability that we prepared. So what happened last year? Well, this chart here shows year-over-year price appreciation for the calendar year 2021. So in 2021, you can see in every single state across the country, housing went up double digits, in some places as much as almost 30%. And there were a lot of factors at play pushing this up. Number one was no inventory. If you wanted to buy a house, there wasn't one available for you to buy. We had supply chain issues affecting builders, so they couldn't get the materials they needed to build homes. We had companies telling their employers, hey, you can work from home for indefinitely. And so for that reason, we saw people fleeing the traffic-ridden and sometimes crime-ridden metropolis areas, whether it be LA, San Fran, and going, since now they don't have to commute to work, they could go work in the mountains of Idaho or Utah. Or if they were paying really high state income taxes, they could go to Tennessee or Florida where there was no state income tax and keep a lot more of their dollars. And so it's important to point out this price appreciation that we saw in 2021, while it really helped out people in the real estate industry or homeowners, it wasn't sustainable. If we would have talked to our clients last year when inflation was kicking off, they said, it seems like we need to quit printing money and cool off this inflation. And so the Federal Reserve has jumped in just to do exactly that, because otherwise you either start to have bubbles form, or we'll have an era where, a manufactured home on an acre is a multi-million-dollar home if we don't cool off this price appreciation quickly. And so the Fed has jumped in. When the economy was sick and our people were sick during the pandemic, the Fed needed to stimulate the economy. They needed to make more economic activity happen. And the way to do that is to reduce borrowing costs. And so during the pandemic, we saw the Fed lower rates to all-time lows. And what this meant is basically you could borrow money for free. And when you can borrow money for free, people and businesses go and buy new equipment, hire new employees, and it helps stimulate the overall economy. But what we saw happen is we arguably might have overstimulated the economy, and the economy returned to its healthy status, but then it got a little too white hot. And when things get white hot, the Fed has to step in and cool things off. And the way they do that is making money more expensive to borrow or raising rates. And you might have heard already this year, there's been quite a few rate hikes to try to combat inflation and this white hot economy that we saw in 2021. And so at the first of the year, if you went to buy a house, you could have borrowed money for, in some cases below 2%. Since then, now that the Fed started raising rates, the average 30-year fixed rate mortgage is closer to around 5.25%. So it's a lot more expensive to borrow money. What that means is if it's more expensive to borrow money, less people want to buy things or buy houses in this case with borrowed money. So that inventory problem that we've been struggling with should start to resolve itself. And let's see if it did. Now, those rates that we talked about going up should disincentivize buyers to borrow money and should mean there be more inventory. And we're seeing that hold true. As this red line is inventory, the blue line is interest rates. You can see they go up hand in hand. And there's some seasonality to be had in terms of when we analyze inventory, because every early summer, late spring is when we see the peak amount of listings. But it's important to point out, in February of 2022, we only had around 370,000 listings on the market. Now we got about 750,000. So we essentially doubled the amount of active listings, the amount of inventory that's out there for people to buy. In many cases, because affordability, people can't afford houses anymore, or they don't want to borrow money at a much higher interest rate. And when we talk about that seasonality, you can see every late spring, early summer, there's a peak amount of listings, but still, people would say, oh, a lot of realtors might say, well, the reason there's so many listings on the market isn't because the market's kind of in a stagnant state. It's just because it's summer. This always happens. Well, we have more listings than we've ever had in the last 5 years. So that would kind of prove that point to be invalid. And we're starting to see, the opposite reaction from the action of the Fed. So what goes up in many cases must come down. And some of these more appreciated markets like Idaho and Utah, we're already starting to see price cuts or price improvements, as the real estate industry calls it. And there's a few reasons for that. If it costs more to buy money, people don't want to buy stuff anymore, especially at highly inflated prices. So that's going to put downward pressure on sellers. A lot of people have been priced out of this market at this point, and so there's less people in line raising their hand saying, I want to buy a house. And at the same time, if you have a 2% mortgage on a home that you purchased maybe five or so years ago and refinanced, you're not going to want to trade in that 2% mortgage for a 6% mortgage, even if you need to change homes. You might just use, some of the equity in your highly appreciated home to make improvements at your existing residence instead of, entering the market and buying a new home. So all this downward pressure means there's been more price cuts than any time in the last really 7 years since Redfin started recording MLS data. And this, if you're on the buy side of things, is a good sign. The real estate market was arguably a little too white hot. This is indicative of us returning to healthy levels of economic activity in the real estate market. And so with sub 2% borrowing costs, when you can borrow money basically for free, we saw essentially 70% of real estate transactions at the beginning of this year going into bidding wars. And now home buyer competition in those bidding wars has dropped to pre-pandemic levels. These are all, effects of the Fed stepping in to try to cool things off before they got too hot. So if you're thinking about buying into real estate, let's look at a little case study and see how things have changed rather quickly as of late. So we took a look at a Mr. and Mrs. Smith, just a base case here to show you, hey, how have these rate hikes really affected the balance sheets of the individual buyers out there in the real estate market, and why maybe are there less people in line to buy houses? So Mr. and Mrs. Smith are, they're young first-time home buyers. They've got a household income of around $120,000 between the two of them, make decent money. They got some car payments, no credit cards, and a student loan that they're paying off. So each month before they buy a house, they're spending about $1,100 on debt. And so one thing that's important to point out, to get approved for a mortgage nowadays, thanks to what happened in 2008, there's certain guidelines that you have to meet. That wasn't the case in 2008, but it is the case now. And lenders usually like to see your debt payments be 36% of your overall income. So we can see their current debt right now is $1,100 a month. Their income, $120,000 a year, but around $10,000 a month. So before they buy a house, their debt to income is about 11%. So they're in pretty healthy range. They can afford to buy a home. And so at the beginning of the year, if they wanted to buy a $500,000 house with a 10% down payment at 2%, their payment, as you can see, would only be about $1,600. And in addition to their existing 11% debt, they'd be at a really healthy 27% debt to income. They'd get approved for that mortgage in a heartbeat. And if they wanted to stretch their limits and max out, go all the way up to the 36%, they could afford up to a $726,000 home. So there's a huge market for these buyers, Mr. and Mrs. Smith. There's plenty of houses available out there for less than $726,000 that they are in the market for. But what happens is rates start to go up. You can see just a 2% increase in borrowing costs or a 2% increase in their mortgage means they're going to be paying over $2,000 now for a $500,000 house. And their payment actually, even though rates only went up 2%, their payment went up almost 30%. And they're starting to get close to that 36% barrier that we want to keep them under to arguably make a healthy home purchase. They're at 32.5% debt to income. And now their max house budget, just by increasing the amount of money they're going to be paying in interest, has went down all the way to $573,000. So there's a huge set of homes in that $570,000 to $730,000 price range that they couldn't get approved for anymore. They're no longer in the market for. So those sellers have a couple options: find another buyer or reduce the price to get Mr. and Mrs. Smith back in the market for their home. Now, we saw already rates for the 30-year mortgage are averaging around 5.25%. So what happens at 6%? You can see their payment at 6%. Now they're paying $2,700 per month. And their debt to income, if they want to buy this $500,000 house, is a little bit over that goal of 36%. They're going to be stretching to buy a $500,000 house. If they wanted to max out their budget at the debt to income rate of 36%, they're only going to be able to afford a $467,000 house. So you can see just minor changes in these borrowing costs pull them out of the market for a whole set of price ranges in terms of houses that they're looking to buy. And interest rates have been there before, but let's say they went up to 10% now. They can only afford, a $334,000 house if they want to keep their housing budget or their debt to income under that 36%. And if they were to buy a $500,000 house, they're going to be house poor. 51% of their income going to be going to their housing expenses. And these are conservative estimates that we've used. So you can see as interest rates go up, it really starts to price people out of the market, at least at existing price levels. And therefore, it starts to force sellers to have to pull their price down if they want to, have a market or have a pool of people that are eligible to buy their house. For that reason, going forward, we're expecting real estate to plateau, if not come down a bit. There's still plenty of demand out there pent up, but it's coming to a screeching halt and will continue to do so if the Fed keeps raising rates. And so it just means be careful. If you bought a house and you have a healthy amount of equity in it, a healthy interest rate, you're a winner through all of this. Where you could lose is if you were to buy a house at these inflated prices of today and this downward pressure continues. And there you could buy a house at a high price and be forced to sell it at a low price if you're not careful. So we'll see how these rate hikes continue to shape out in the market, but it's obvious there's some good signs. If you're a buyer, there's a lot more inventory out there, and you can always consider buying a house today and then hoping rates go down and refinancing in the future. And that's why we think that there's still some demand out there for real estate. But if the rates continue to go up, it's only going to force more pressure on sellers to either reduce their prices and pull more and more buyers out of the market entirely. So thanks so much for tuning in on our real estate market update. If you have any questions, either follow up to this or on other subject matters, we ask you not to hesitate to reach out. You can reach us either by the comments or hit us up by email or reach out to our website, timewise financial.com. And thanks for watching.